Just got a new report on the state of the job market here in America, and the stock market loved it. This report helped the stock market break new record highs because it said three things. Number one, it said that the job market might not be as bad as you originally thought. Number two, Americans are feeling confident in the future of the job market. And number three, because Americans are so confident in the future of the job market, they're more likely to quit their jobs now. So what I want to do in this video is break down, number one, what's happening in the job market, but then number two, I want to expand upon that and talk about how this ties into the broader economy, because the Federal Reserve Bank is going to be meeting very soon. And this can impact what they do with interest rates. And then third, I want to wrap this video up by talking about how this ties into the housing market, which might seem like a little bit of a stretch, but if you stick with me until the end of the video, you'll see how this all ties in together. So let's jump right in, starting with what's going on with the job market, because this report said that we are seeing an increase in the amount of job openings in America. Now, what does that mean? Well, according to Wall Street, that's good news because that hopefully means that employers are now hiring more people. Because leading up to the election, there was a lot of uncertainty. Nobody knew who was going to win the White House, and with us not knowing who's going to win the White House, that can create uncertainty as to future economic policies and investment plans from the government. But what this news means in the job report, that we're seeing an increase in job openings to Wall Street, that means that employers are hiring more people, which means employers and companies are willing to invest back into their companies, which is why investors love that news. The second piece to this is that you can start to see that maybe Americans are starting to feel a little bit more confident in the economy. Now, you might remember that about a week or so ago, I made a video talking about how consumer confidence in America has now hit a new high, where we saw after months of consumer confidence falling, we're now seeing consumer confidence finally rising. What does that mean? That means that Americans feel more comfortable spending money. Why is that important? Because if Americans are comfortable spending money, that can help stimulate the economy. But now we're starting to see how that can also tie into the job market. Let me read you a line directly from Yahoo Finance. By the way, yes, we covered this in market briefs, but this is what the article said. The rise in people quitting their jobs falls in line with recent data from the Consumer Confidence Survey, which recently hit its highest level since July 2023, driven by labor market optimism. What does that mean? We are seeing the highest level of consumer confidence in more than a year. But along with that, we're also seeing more people feel comfortable quitting their jobs, and we're also seeing more people actually quit their jobs. Now, most people are not going to quit their jobs unless they feel like they can actually go out and get another job. And for the last number of months, we've been seeing people quitting their jobs drop. Between May and October of this year, the number of people quitting their jobs has been dropping month over month, because people have been concerned about the economy and the job market, and people did not want to quit because they were scared that if they quit their job, they might not be able to get another job. So you can start to see how that creates worries in the economy and the job market. Well, what this report said is we're finally, after many months of job quitting declining, we're now seeing an increase in job quitting. And this to Wall Street is good news, because if people are feeling more comfortable quitting their jobs, maybe that means that people are feeling more confident in the job market, because maybe that means that the job market is recovering even more. Now, of course, if you want to stay up to date on what's happening in the economy and the stock market, the housing market, the crypto market, and the global economy, my team at Briefs Media publishes a free newsletter called Market Briefs 6 times a week, where we break it all down into a fun and witty and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every single morning. So if you have not joined yet, it is completely free. And if you want to join, all you got to do is click the link down in the description below to join. But this is where Wall Street has interpreted this data to mean that the job market is growing, and maybe it's not as bad as you thought. Now, the interesting thing about this is if you ask a lot of people, if you walk down the street and ask the average person about the job market, you get a lot of news or a lot of people saying, yeah, the job market isn't that good. It's hard to find a job. I'm not getting a raise. I can't get a pay bump by quitting and going to another company. But the data says something different. And that's why it's so interesting, because if you talk to people, anytime I talk to somebody about the job market, I hear the opposite news. Barron's did a report on this very recently that yes, the job market is strong according to the data, but the average person says that the job market sucks. So it really is a tale of two job markets, where the people that are doing well in the job market are doing really well. Everybody else is not doing so well. That's kind of what's happening in the job market, but you're getting the same tale of two stories in the economy as well. Because on one hand, all the data says that we are seeing the strongest economy of all time. Unemployment is super low, inflation is not a problem, that the economy is growing still at very high speeds. But the average person is not feeling that wealth. So it's a tale of two stories. You have two people in the job market, the people that are succeeding in the job market doing very well, everybody else not doing so well. In the economy, you have the investors that are getting rich and everybody else that's not doing so well. And this is where I want to tie into what's going on in the economy, because the Federal Reserve Bank is going to be meeting on December 18th, which is just around the corner. Can you believe that? 2025 is right here. And the Federal Reserve Bank is going to make a decision on what they want to do with interest rates. More specifically, are they going to cut interest rates again? And when they make this interest rate cutting decision, they take a look at two things. Number one, they take a look at inflation. Number two, they take a look at the job market. That's what their mandate says. And their goal is to bring inflation down to 2%. And number two, they want to keep as many people employed as possible. Now, inflation is not at 2% by any measure. And the most recent inflation data actually said that inflation increased month over month. It wasn't decreasing. So the inflation is not where the Federal Reserve Bank wants it to be, but anytime the Federal Reserve Bank talks, they keep saying that we are on pace. We are en route to 2%. When are we actually going to hit it? Nobody really knows. Why did they pick 2%? Nobody really knows. Why don't they want 0% inflation? Well, inflation benefits the investor, and the Federal Reserve Bank, while they say they're there to benefit everybody, they're really there to benefit the investor. So take that for what it's worth. But on the job market side, the Federal Reserve Bank says that they've been wanting to cut interest rates as a way to keep the job market strong. Now let's put this all together. If inflation is not at 2%, and inflation might potentially be going up a little bit, and the job market, according to the data, is strong. Sure, I mean, if you ask the average person, they might be struggling in the job market, but if you look at the data that the Federal Reserve Bank is taking a look at, all signs say, hey, the job market is completely fine. I mean, we have still some of the lowest unemployment that we have seen in the last 50 years. We have more job openings out now than 2 months ago. We have more people feeling confident in the job market, so they're more likely to quit their jobs. So based off of the data, you would think that the Federal Reserve Bank is not going to cut interest rates. Well, according to Wall Street, at the time of me recording this video, there is a 73% chance that the Federal Reserve Bank is going to cut interest rates by 0.25 percentage point before the end of the year, which might have you wondering, well, why are they doing that? Aren't they saying that they don't want to cut interest rates to potentially spike inflation? How is this going to all tie in together? Well, this now also ties into what I was saying in the beginning of the video, which is, of course, the housing market. Because there are two main factors that are contributing to the high inflation numbers that we're seeing. You want to guess what they are? Number one is car insurance prices, and number two are housing costs. Those are the two largest inflationary factors that are influencing inflation, because car insurance prices have skyrocketed and housing prices are still going up along with rental prices. Have they slowed down their growth? Yes, in many pockets. Not the entire country, but in many pockets they have slowed down the growth. In some neighborhoods, we've seen price cuts, but still across the country, generally, when we take a look at it at a national level, home prices are still increasing. Now, of course, you got to understand real estate is localized. Every neighborhood is different. But if you look at it from a national perspective, home prices are still increasing, just not as fast as before. But this increase in home prices is still contributing to the higher inflation. And one of the biggest drivers of home buying demand is none other than mortgage rates. So let's put this all together. The Federal Reserve Bank now is talking about cutting interest rates to continue stimulating the economy, to continue stimulating the job market, but they're still worried about this inflationary problem. Every time we start cutting interest rates, that could hopefully, one of the goals with cutting interest rates is to make mortgage rates a little bit lower. But every time mortgage rates fall, you see a surge in demand of people wanting to go out and take advantage of the lower mortgage rates. We saw this happen approximately 1 week ago. We saw this little dip in mortgage rates, but we saw this big rise in mortgage applications right after the election happened. Now, the question is, are we actually going to see mortgage rates fall? Because mortgage rates don't just depend on what the Federal Reserve Bank interest rate says. The Federal Reserve Bank is the central bank in the United States. Now, I know they're called the Federal Reserve Bank, but they're not actually part of the federal government. It says so on their website. They're not actually a reserve because they don't hold on to any cash reserves, and they're not actually a bank because you and I can't go there to deposit money, but they have the ability to set interest rates here in the United States. Now, that doesn't mean they set your mortgage rate. They set the interest rates that banks charge each other. So if the Federal Reserve Bank cuts the rates, they cut the federal funds rate, that means the cost to a bank to borrow that money goes down. So they should, in theory, have more margin to potentially lower your mortgage rate. But banks have to also take a look at what's happening in the broader economy. More specifically, they have to take a look at what's happening in the bond market. A bond is a loan, and you have the ability, you, your bank, your broke cousin Bunty, everybody has the ability to lend money to the United States government. This is what's considered the risk-free investment. It's a risk-free loan. That's what it's considered. And so if you can loan money to the government and the government's going to give you an interest rate in return, the bank has to charge you more interest than what the bank is going to pay. Because if the government is going to pay, hypothetically, a 6% interest, why would the bank want to loan you money for 5% when they can get a higher rate of return from the government and get a guaranteed return? So this is where what the bank likes to do is also take a look at what's happening with these loans to the government. It is called a treasury. And more specifically, the bank likes to take a look at the 10-year treasury. So when you're trying to understand where our mortgage rates are going to go, just go to Google and search the 10-year yield, and that'll show you where the 10-year treasury yield is, the interest rate on the 10-year loan to the government, and that will give you an indication as to if mortgage rates are going to go up or down because it kind of follow the 10-year yield. Now, there's a lot of factors that will influence this 10-year yield. It could be concerns about inflation. It could be concerns about the economy. It could be concerns about geopolitical issues. All these things can influence that 10-year yield, which will then ultimately influence your mortgage rate. But now going back to what we're talking about with the economy. The Federal Reserve Bank has been talking about how they want to stimulate the economy and how they believe inflation is going to keep falling down. But if they keep cutting interest rates to try to bring mortgage rates down, they run the risk of, well, if mortgage rates actually do fall, you could see a surge in demand of people wanting to buy a house, which could push home prices up. Now, this is where some people are saying, well, no, if mortgage rates fall, not only are people going to want to buy the house, but you're also going to see people sell their houses more. Why? Because you have a lot of people that are locked into a 30-year fixed rate mortgage at under 4%, so they don't want to sell their home. Because if they have a 3.5% mortgage, they'd have to sell their home and then go to a 7% mortgage, which is why people are not wanting to sell their homes. In fact, let me give you some data from Realtor.com. This is where we were in the middle part of 2024. About 21.5% of outstanding mortgages have an interest rate below 3%. About 35% of outstanding mortgages have an interest rate between 3 to 4%. About 18% of mortgages have an interest rate between 4 to 5%. So you have the vast majority of homeowners sitting on a mortgage under 5% and many of them sitting under 4%. So if you have a 3.5% mortgage or a 2.5% mortgage, chances are you don't want to sell and go to a 7% mortgage. And that's why some people are saying, well, if you cut mortgage rates or if you get mortgage rates lower, not only will people want to buy houses more, but you'll also have more inventory on the market because sellers will be more likely to sell. We are starting to see more builders start to build homes, but that takes time. And we haven't seen the big surge in building to create more inventory, because while we are seeing more inventory today than 12 months ago, a lot of buyers are still saying that there's not that many homes available for sale. And this is where, again, what I've been talking about for a long time is that our economic system is designed to benefit investors. Why do I want you to understand this? Because, well, the holiday season is just getting started. And what we saw, this is interesting, is that over the holiday weekend, the Thanksgiving holiday weekend, we saw Americans spend $41.1 billion online. Why does that matter? Because that's more than 8% more than where we were last year during that same holiday weekend. Why does that matter? Because over the last 12 months, this inflation rate was 2.6%, which means that Americans are spending more money, not just because of inflation, but because they want to spend more dollars. Why does that matter? Because we're also seeing more credit card debt now than before. we're also seeing Americans save less money now than 12 months ago. So Americans are saving less money. Americans have more credit card debt. Yet Americans are also spending more money during this time. Why does this matter? Because over the last 5 years, incomes have risen by around 20% on average. The stock market, more specifically the S&P 500, has grown by around 93% in the last 5 years. This money game is designed to benefit investors. And if you don't understand this, you're going to be the person making everybody else rich. And that's why I want you to understand the game. I want you to understand what's happening in the markets, and I want you to understand how you can build wealth, because the reality is the economic system is designed to benefit investors. Now, does this mean that investments always go up? Does this mean that the stock market always goes up? Does this mean that the housing market always goes up? Absolutely not. Markets go up, markets go down. Recessions are a part of our economic system. You've heard me say this pretty much every single video. But I want you to understand that over the long term, investing is how you build wealth. And unfortunately, most of us don't learn this in school. So you're going to have to go out of your way to learn how to do this. But that's where I hope that my videos can help you understand that you have to be an investor to build wealth. In order to be a successful investor, you have to be investing for the long term. And in order for you to get better returns, you have to invest in your financial education, learning how do you analyze an investment, learning about the different ways that you can invest your money. And of course, Market Briefs is a free resource that I created, which will keep you up to date on what's happening in the markets with a free newsletter. If you want more education, we do have more advanced products, more advanced stock market research, more advanced market research for those of you that are interested, but start with the free stuff and start investing in your financial education. That way you can build your wealth, because a lot of people are spending money, but the investors are the ones that are making money. And I want you to be on the side that's making money. And once you build your wealth, go out and spend as much money as you want, because now you can afford it. I just don't want you to spend the money that you don't have buying things to make you look rich, because now you're just making somebody else rich. I want you to make yourself rich first, because that's how you really build wealth.